Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 18th of July. I'm Daniel Lam, your host for the podcast. In the weekend before last, during one of the numerous birthday parties that I had to take my baby boy to, the parents of one of his best friends asked me about my thoughts on asset markets. And I told them that there seemed to be limited downside to the Japanese yen. And subsequently, the dollar yen did fall sharply from 145 to around the current 139 level. Now, the game changer was, of course, the run-up to the expectation and then the confirmation of a weaker than expected US CPI figure last week. Now, inflation has not yet been beaten, but it does appear to be trending lower. It is worth mentioning that this was the second consecutive US economic data release to come in softer than expected, after the US labor report on the 7th of July. Now, this is likely to put a cap on US Treasury yields and also leading to a lower US dollar, as markets increasingly believe that the end of the FOMC rate hike cycle is upon us. Yes, the US economy is likely to slow down in the second half of this year, and recession may hit us in the first quarter of next year. But the removal of tail risk from higher rates and tighter policies should allow global rates volatility to come off, which is likely to lead to a weaker US dollar. So at the start, low-yielding currencies such as the Japanese yen may rally as markets unwind short positions in such currencies. Now, Japan economic data continues to perform strongly versus expectations. And our view is that the BOJ may tighten policies in the fourth quarter of this year. Thus, we believe the dollar yen may reach 130 over the next 6 to 12 months. The euro is the other major currency versus the US dollar, and it broke above the key trading range between 1.05 to 1.10. Now, given the recent strong move, it may pull back over the very short term to levels such as 1.11. That is the short-term support as well as our 12-month forecast. However, do note that our SCB research colleagues recently pointed out that the positive yields across the curve in euro area government debt may be a potential driver for reserve managers to increase euro allocations in their portfolios. Now, they pointed out that the current euro reserve allocation is at 19.8%, which is just above the cycle low at 19.1% in December 2016. And the market may be underappreciating the potential for diversification flows from US dollar into the euro. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.